Hi everyone, it's Shkreli here, and we're going through the classic example of does it make sense to buy or rent real estate. A lot of people say, well, I hear a lot of people say, well, it makes a lot more sense. In fact, my own parents would say this. It makes a lot more sense to mortgage, to buy, in other words, because at least you're getting some equity. You're gonna own something at the end. Well, I think that's sort of a common misconception. I think it really depends on the situation. So let me show you this model I'm building that'll illustrate that. So here's the house value I have. I wanted to do 5 million or 10 million, but somebody told me it would be a better idea to pick 500,000 as a more realistic home price. I think that's fair. And we have the house value increasing by 3% a year, which is one of the scenarios where I think you would want to buy. Now, of course, you don't know in life if something's going to increase or not. So, but let's assume it increases 3%, and let's assume that you have $30,000 a year to put towards the house. You have a 6% mortgage that's a fixed rate for forever, and your mortgage costs will therefore be roughly $24,000 because you're borrowing $400,000 for the house, and it's at 6% a year. So every year from now on, forever, as long as you have this loan, you'll be paying 6% on the balance. So let's see how that balance gets paid down. So the debt you have accrued is $400,000, but you have that extra pay down of $6,000. So the next year's debt will be $400,000 minus $6,000, which would be $394,000. So your mortgage cost for this year will be $394,000 multiplied by 6%, which will be $23,640. And here's where your pay down will be a little bit extra. So it will be, instead of $6,000, it will be $6,300. So you can keep, hopefully this will work, you can keep kind of extending this over. I think this should work. Let's see. Yes. Cool. And it appears that you'll basically never pay off the house in some cases. But one of the things you can do is that your annual budget you hope will increase as well. So you can forecast that maybe that increases at 2% or something. Maybe it's I think realistic. So subtract these. So you can see here that you have you've reduced your debt from $400,000 to $300,000 in 12 years. The equity you have in the house is roughly the difference between these two things, and it is exactly the difference. And you can see that in the case in this case where you can, let's say, buy this property with debt over this time period, if the house value is increasing at 3%, you've made a value of you've made $212,000 by owning this house, because in a buy situation you own the house, right? So, but you've made about 3% per year. If you rented the same house, what would that look like? Basically, it would look sort of the same. Other than the fact that you had you weren't building any equity. Now, really, you could have taken this extra pay down line and invested in anything you wanted. You didn't have to invest in the house. So basically, the way I look at this is in essence, you're speculating. You're speculating that the house price will go up in value. And to me, that's not a speculation I want to take, because if the house price goes down in value, you're basically you borrowed money to buy something that was overvalued. And there's no reason to believe that your house in one neighborhood is going to be any better than the house in another neighborhood. Real estate values have gone up a lot in the United States, so people are lulled into this false security that I think that they'll be making a great investment by buying property. And certainly that's been true for many, many years. It's been a better investment than the stock market or the bond market. for instance. But I don't think that just because something has been a good investment before, it'll necessarily be a good investment for the future, which is, I think, one of the cardinal sins that people commit in logic, is that they see something has happened before, therefore they assume it'll happen again. And this must have been very reassuring the first time the sun set that it arose again. And that the logic that something continues to happen, it should keep happening, is something that is a logical fallacy. In some cases it should, in some cases it shouldn't. It rained on Monday, it doesn't mean it'll rain on Tuesday. It might rain 2 days in a row, but you would be fallacious in assuming that, or foolish in assuming that it will rain every day for eternity. So house prices have gone up, but there's no reason that they'll continue to go up. So in cases where house prices are going up, it makes a lot of sense to borrow money at a reasonable rate to finance the investment. In cases where you don't know if they'll go up, or you're not willing to borrow what is usually an enormous amount of money. Mortgage is a debt. In fact, the people who sell mortgages have successfully changed the name of "here's a huge amount of debt that you will owe us" to mortgage, because it sounds nicer. Oh, it's a mortgage. Well, it's a little scarier if you think of it as, here's an enormous amount of debt that is vastly more than you can probably afford to pay, and you're buying something that you don't really know if it's going to be a great investment. Does that sound like a good idea? To me, it is like gambling. We haven't talked about we haven't talked about property tax or maintenance on property and things like that. But yeah, it can be quite foolish if you want to speculate your life savings and your future and your financial security on something that you're not certain is a good value. You have to do a lot of research in real estate. I don't know how to do it personally, but let's see. House in Brooklyn. Let's do quick Brooklyn houses for sale. You can see $500,000, $1 million, etc. Some of these are apartments, right? There's a townhouse in Brooklyn, not a great neighborhood there, but that's okay. Here's close to where I grew up, $1 million house. Okay, well now let's go to Detroit. Let's see what happens there. Let's buy a house in Detroit. Okay, different prices here. Very different. $80,000, $3,000, $5,000, $50,000. Look at that, $50,000, 3-bedroom house, 2,000 square feet. There's a foreclosure for $5,000, $20,000, 1,600 square feet. And if we go back just 2 clicks to Brooklyn, the same amount of square feet, the same amount of bedrooms, $1.2 million. $1.2 million. 3 bedrooms, 1 bath, 1,300 square feet. 8 bedrooms, 5 bathrooms, triple the square feet, and $200,000. So if you are a house investor, and you can see from this model that you got to be a very long-term investor, how do you know that Detroit is not going to become Brooklyn and Brooklyn's not going to become Detroit? You don't. Your guess is as good as anyone's. And just because house prices have gone up over the long run, why are you so confident that they'll go up in the short run? And yeah, we haven't even looked at houses in really nice neighborhoods. Brooklyn is a middle neighborhood, middle of the pack, or top end of the pack. But if you look at the very high end of the pack, it's totally different. So, what makes one investment better than the other? Well, if you think you're a really good real estate investor, you should do it professionally. Because there are people who are professional real estate investors, like, for instance, our president was one. And to speculate on real estate is just like speculating on the stock market. And you probably, my guess is, you probably would not borrow $1 million or $500,000 to speculate on the stock market, especially with a high interest rate. The one reason that real estate investing is reasonable is that as long as you're paying your mortgage, you cannot be kicked out of your house. And one of the reasons that it makes sense to do that is that you could conceivably be basically taking a big bet that the house will appreciate. Let's say the house appreciates 10% a year. You can see that you make an enormous amount of money, millions of dollars. But the thing is, in the stock market, if your value is losing, you'll be foreclosed on, in the sense that the margin loan, you'll have exhausted your margin loan. Whereas in real estate, your margin loan kind of goes on forever, which is the one sort of saving grace for house investments. But it's not fun paying a mortgage on an investment. For instance, let's say Brooklyn did become like Detroit. You'd be paying more in mortgage, or as much in mortgage, as almost the value of your house at some point. It wouldn't be worth it. You'd probably abandon the property. So at the end of the day, it doesn't make a lot of sense. I do think that if you can rent forever, you should rent forever. Unless you really have you're willing to gamble, in essence, or the amount of money.
Took over a property with tax properties, took over a property like that.
Yeah, there's an occasional benefits that can be valuable, but in general, it's basically gambling. Now, let's say that you had a different kind of portfolio. Let's say let's say your name is Josh Smith, and you want to buy this house for $100,000 in equity. Okay, you have 401k of $200,000. You've got investments outside of your 401k of $150,000, and you've got a job salary of $150,000, and you've got I don't know. Let's see what else. That's about it. Let's say that's what your financial picture looks like. It sort of makes sense to me that you can speculate on 17% of your net worth. Call it, I don't know if your salary is included in that, but 20% of your net worth, and you have a good salary. That's a reasonable perspective. But if your name is, I don't know, Michael Stone, and you want to do the same real estate transaction, but your 401k has $5,000 in it, and you have $20,000 of investments, and your salary is $75,000, I don't think it makes sense to put 80% of your net worth into buying a home. So that's kind of my perspective, because ultimately you're gambling on 80%. It's better to gamble if you have 401k that's in stocks, you got investments, I don't know, that's in bonds, and you got real estate, and you got a steady job that's paying you well. You're a little bit safer speculating on the real estate on the $100,000. You may take a loss, because remember, you're buying something for $500,000. You're basically buying something for $500,000 that you can't afford. You're buying something, when you buy a house, you're buying something that you can't afford. And you're borrowing money to do that. So you got to pay interest on that.
What if you have $100,000 and you have a choice between getting a mortgage or buying it outright?
Well, typically,
Get the mortgage.
Typically, I'd say you're talking about buying a house for $100,000.
Yes.
Yeah. So, I mean, I think that you're basically saying, do I want to borrow money for this investment or not? And I think that in essence, it depends on your confidence in the investment. So if you really are sure.
The argument is usually that if you are borrowing the money, then you can use that money that you would have spent to buy the house for making money. And that's why they say get the mortgage. But I don't know how I feel about that.
Yeah, I mean, it's a terrible idea. It just accelerates if you make good investments, leverage is what we're talking about. Debt is leverage. The more debt you have, if you're making great investments, the more money you'll make. If you're making bad investments, the faster you'll go bankrupt. You know, and I think the key thing here is that there's no free lunch, that people believe that there is a free lunch in real estate investing. Like this person in the chat here saying, Manhattan will never be like Detroit. Well, Detroit used to be one of the biggest cities in America. And people would say Detroit will never be like Detroit. And this is in our lifetime. In the 70s, Detroit had many skyscrapers and was just as exciting as New York. In fact, it was probably better in some ways. New York almost went bankrupt. New York had a lot of crime. And New York sort of got a bit of a fixer-upper thanks to different management. You know, New York isn't the same as it was 50 years ago, and Detroit's obviously taken quite the nosedive. But there's other cities like Memphis and others that have not done well, where you do not have house price appreciation just because it's a house.